Welcome back to the NWR Virtual Resources Series. My name is Kerry Stevenson, and next up we have Highfield Resources. ASX code is HFR. Now, Highfield Resources, obviously ASX listed company, but they're potash, and they're focusing on the construction, ladies and gentlemen, of its flagship low-cost, low-capex Muga project in Spain. And they got granted that concession in July this year. I'm pretty excited about this because potash is what's going to feed the world, and it's going to be a very interesting commodity to look at. Joining me today is Ignacio Salazar. He is the CEO, and I hope I pronounced your name correctly. I've tried so hard before. Ignacio, welcome to the NWR Virtual Resources Series. Take it away. Tell us all about Highfield. What are you up to?
Okay. Hello, Kerry, and thanks for the presentation, and hi to everybody. Okay, we go through the presentation. Very excited about this project, and I would like to share with everybody. Constructing, as we say, the next European potash mine. We are the most advanced project in Europe, and well, we go through the disclaimer at the beginning and a very quick summary of what we are going to go through in this presentation. An investment opportunity, the next major MOP potash mine, as I said, very strong market fundamentals, as you mentioned, Kerry, with in fact right now potash prices rocketing up. A few features of this project that we will cover that make it unique: the location of the project in the middle of a very intensive agricultural region. Shallow mineralization infrastructure in place. That means low cost, as you said, low capex, very interesting economics, and that is with Highfield, with a strong financial position, support with the markets, experienced management team, strong local support. We will cover briefly that. Top environmental credentials, very strong environmental features like backfill and upgrading salt and residues, and some upside opportunities. But basically, of course, right now the key emphasis is on the Muga project and building the mine. So this is where we are right now. I mean, as you see in that map, that is Pamplona. It's a city well known because of the bull runs, although we've been for the last couple of years in pandemic, so they were suspended. But basically, all the team is based in Pamplona or closer to the project, which, as you can see, the Muga mine, 45 kilometers going to the southeast. There is a motorway going in that direction. These are the tenements that we own 100%, and the Muga project in the middle of them. The artistic impression of the plant, as you see there in the top right corner, and a map of Spain and where we are located, very close to the border with France as well. ASX listed, you mentioned that. This is an MOP project in two phases. The one that we are tackling right now, we are building right now, will take us to 500,000 tons of potash. And after that, we will expand, once we are in production, into a second phase with another 500,000 to put us into 1 million of tons per year production. Conventional underground room and pillar, conventional flotation and crystallization processing, so standard methods. And we are right now, we will mention that at the end of the presentation, the status of the project in preparation for construction. So talking a bit first about some of the macro trends about potash, MOP prices, based on very strong fundamentals, as you said, is world population growing exponentially in the next few years, while arable land keeps decreasing. So the only way to make that equation work is with fertilizers, and of course, potash is key in that challenge. And basically, as you see in the right of that slide, with crops prices really rocketing up recently, potash prices followed after that, with basically demand getting stronger from agricultural sectors, and supply not coping, for several reasons, but very much allowing us to go through a very, very bullish environment right now in potash. Just a small comment about within potash is always good to make a distinction between MOP and SOP. Basically, we see both with prices coming up significantly, but as you see on the right side, the premium of SOP is becoming smaller as during this process. I mean, potentially that is due to the fact that as you see again in the left side of that slide, the MOP market is a lot bigger than the SOP market globally, and also that there are quite a few SOP projects coming or moving forward, while the MOP projects are a lot less. And as I said, in our case, we are the most advanced project in Europe in MOP potash. So why Highfield, and now coming back to the project itself, and I think the three features that make this project special and are really inbuilt advantages of cost advantages of the project. Basically, I mean, in this slide is the first two reasons for that. The top left shows the mineralization is starting at a depth of 350 meters. When you compare to typical projects in Canada and that are recently well-known projects there, you typically are 1,000 or more meters depth. And that implies a lot of times that you need to build a shaft to reach that mineralization. In those projects, you have aquifers, typically in potash projects, sitting on top of the mineralization. That is not only makes a lot more challenging, but also it forces the project to build the shaft through the aquifer and everything that means, which is you need to freeze the aquifer just to build it. So this mineralization, shallow mineralization in our case, will allow us to build 2 declines and to access the mineralization a lot easier. Is of course a lot less expensive to build it and a lot more efficient to run it and to maintain and operate going forward. The other 3 photographs there are pictures of infrastructure, in fact, that are around the mine, and that make, again, this project compared to many other MOP projects or potash projects in general special, is that the infrastructure, world-class infrastructure, is already in place. I mean, a lot of these motorways and railways have been built in the last few years in Spain with the support from European funds and development in Spain. That is the motorway that runs from Pamplona to the mine gate, to the mine site, and then the electricity substation that is also very close to the mine site as well. The port of Bilbao is the biggest, the largest deep water port in Spain. Is also at 200 kilometers from the mine site, and there are other ports in closer even than the Bilbao port. So that is all this infrastructure in place when typically these projects have to build for the sake of the project, and we will not need to do that. And the third element, and probably the most important, is the location of the project. As you see there in that wall map in the north of Spain, we are very much in the center of a very intensive agricultural region, all the north of Spain with crops, cereals, the south of France with wine and etc. In deficit of potash right now. The whole of Europe is in deficit of potash as well. So for us, those will be our, north of Spain, south of France, probably a niche market for us, and Europe as well, a very important market. Together with, we see Brazil, as you know, very important within the potash business and the potash market. With a demand of 10 million out of the 70 million globally. And again, in deficit of potash, we have a lot easier and quicker access than the alternative coming from the middle of Canada and going through the Panama Channel to reach Brazil. So these 3 elements are very important. This one, transportation cost, of course, will make a big difference in such a high volume commodity as potash is. Again, just our sales strategy is going to reflect what I was discussing before, what we call, you see in the center, of that map local market. We call for us, we will are targeting half of our production to be to service this market, 25% to cover the rest of Europe, and another 25% to South America, mainly Brazil. As I said, that it helps also because of seasonality reasons and just to balance our production with the request of demands. No, we have MOUs. I mean, because compared again to other potash projects, we feel extremely confident on the market side. We have already MOUs signed to cover more than our phase one production, and they are non-binding so far, but we are simply we feel very confident we can make it binding whenever is the right moment for Highfield to move forward. So this is probably a concern to many projects of this type. For us is a very, very important strategic advantage. I mean, these three elements are, of course, implying a low cost. But in addition to that, as I said, because 75% of our production is targeted to the European market, and the European prices are trading at a premium, have been trading at a premium traditionally, as you see there, $100 per ton, higher than the global markets. We will also have the advantage of higher prices than many other projects, as we are supplying service in the European markets, and we are expecting to see Europe season, agricultural season comes a bit later than the rest of the world, that to pick up and that gap and that premium to remain. So with that,
sorry, Ignacio, let me interrupt you. Why are the European prices? Why do they trade at a premium to other markets? It's interesting.
Well, not very much a supply-demand situation. I mean, and coming back to the previous slide, because the alternatives, Canada to some extent is setting the price for worldwide, and Europe is probably the most difficult market to access from them. So they need to build extra cost that of course we will not have to incur, and that means that is a lot more. It takes more effort and more cost to get there, and then the supply is not there. No, as I said, is in deficit. So that is a trend that we've seen, and we see going forward that is not changing. That is not changing. If anything, is becoming a lot clearer that difference is becoming clear, the difference of Europe with the rest of the world. So when you consider those three, I think very clear differences of our project, and well, the fact that we will be supplying Europe with a premium, that means that when we compare to peers, the margin we result in our project in a top quartile, top class margin in the industry, and that is of course very important in these cyclical businesses, not to be top of the class. I mean, that is all about margins and profitability, but again, those, I mean, the fact infrastructure is in place, and shallow mineralization, no shafts, and also that we don't need to build a lot of extra equipment, means that from a Capex and investment perspective, to build the project, the mine and the plant will be a lot more efficient than other projects when we compare to potash projects around the world in terms of Capex intensity, meaning the amount of money we need to put in place to invest divided by the production. So we come up, or Muga comes up very good in that comparison. Typically, I mean, around half of the Capex intensity of other projects. Around, I mean, we are looking there at both phases. In this case, around half, $600 per ton, compared to 1,200, 1,000 of other projects. So just talking about these two phases, remember I said $500,000, and to come up to one as soon as we start the production. So the first phase will be 370 million euros. The second phase is an additional 200. So of course, very economic to run into the second phase with, well, half of the Capex you are going to duplicate your production. When you put all that together, and based on the information that we have already published at the end of 2019, the project comes with very strong, compelling financials, close to 2 billion euros, and EBITDAs about 300 euros at full production with 1 million tons. These are the numbers that were published in 2019. I mean, very much the Capex numbers and the cost and the NPV, IRR of 25%. We are, of course, updating these numbers, just looking at prior to beginning with construction. And of course, we've seen some cost inflation, but on the other side, with the project a lot more advanced and more de-risked, we also have built additional improvements. So no significant, from the cost perspective, very, very much aligned. From the Capex perspective, is a bit of extra money required by the mining concession, but basically things coming along very similar or not materially different to what we have seen already. So where we are, I mean, this is very much about the project and some of the key elements of the project and what makes this MOP project in Europe special, and where we are in the process. Very much, I'm very happy to see the mining concession granted on the 1st of July. I think this year that is something that has taken time, let me put it that way, and I think has been dragging Highfield down a bit for this period until we got to this point, but this is already behind us. So we are really pushing very hard once we have that on everything else that I will explain in a minute. But in addition to the permitting that has been very predominant in let's say in our emphasis and focus in the last few months, engineering, we are ready with the detailed design. We share that with our partner, Acciona, just to move forward, and we are working with them in preparing the agreement. 85% of the process plant equipment has been contracted. Also important, this is the process plant equipment to contract and have access to that, because that again give us the detailed engineering of all the equipment as well, and as well as de-risk the project, because we have a clear understanding of the Capex cost that we are going to incur, so that we are moving forward, hopefully to have 100% of that equipment already contracted. Again, sales and marketing, I said this probably is the most important strategic advantage of the project. MOUs non-binding in place, and we are simply waiting for the right time to make them binding and confirm this the sales strategy of the company. And on the corporate side, recently and after the mining concession, we made a small equity raise, 18 million Australian dollars, to put the company in a strong position moving forward. And we also engaged a bit before that Endeavor to help us with the financing. I should say, talking about the financing, the company a few years ago ran an exercise 3 or 4 years ago where it got approval for a credit approval of 185 million. Basically, we feel in a position that we should be able to get more from banks and in better conditions right now. So we feel very confident, together with the support of shareholders like EMR and Aussie Super, to move forward. And we are doing some work with strategic investors as well. So feel confident with the financial position of the company after this small equity raise, and the work with Endeavor to move forward into construction as soon as possible. Basically, this is the plan of what we are doing in the remainder of the year, what we call pre-construction phase, which very much is, as I said, the really prepare and finalize the agreement with our construction partner. Acciona will do most of the construction. We will keep part of that to make sure we keep a bit of a competitive tension in the process and ensure competitive prices. The procurement of long lead items, as I said, we are moving forward quite well, 85% now, and moving to 100% in the next few weeks. And as well is still some work with administrations, and now a lot more prescriptive in the sense any construction in Spain requires construction licenses. So we get the plant in Navarra and the mine gate in Aragon, the two regions. This project, as you know, is in the middle between these two regions in Spain.
Almost time's up, Ignacio.
Oh, okay, I am there. I think is this the last prior to wrap up. So basically financing, as I said, with Endeavor, working on the credit side and the funding package, really right now looking at the strategic partners and working with our shareholders to make sure that we run the process smooth. And on the construction is what, I mean, this will be prepared us to start construction that we plan to start in the springtime next year, 2022, and that take 2.5 years, sometime in 2024, be in operations. I mean, we put that arrow, you see early works above ground installations. If it's possible, we have the chance to start with electricity works and some surface work before we start with the bulk. It's a lot more efficient as well if you have your own electricity. So plenty to do right now. Very keen to move forward as quickly as possible. And just Kerry, thanks for I wrap up with this. Strong market fundamentals, as I said, with potash, I think is a sector with a very, very strong growth forecast. Built-in cost advantages, the three that I referred to, the shallow mineralization, it means no aquifer and no need for shafts, world-class existing infrastructure that we don't need to build for the sake of the mine, they are already there. And the fact that we are in the middle of this European agricultural region which is in deficit of potash. That means very interesting margins, low capex intensity as well, and then impressive economics that we are only keen to get to materialize right now, because in terms of timing, we are very much moving to construction forward, and that is on the back of experienced management team, a strong board, and committed shareholders. So that is what I had in my presentation. I'm very open to any questions or any comments, Carrie?
Yeah. From Daniel, what is the annual throughput capacity of your proposed process plant?
So because this, there is a lot of, I would say, it's very important to be very stable in terms of production. So the one, as I said, the first phase will be half a million tons per year. And we will be, all the mine plan and all the economic models we are running, try to keep that production very stable, meaning that we are working practically not at full capacity, but close to full capacity. So that will be the 500,000. And then with phase 2, we will move to 1 million tons of MOP.
You recently did the capital raise, as you outlined in your presentation, 18 million. Where are you going to be using that money? Is that for on what part of the project?
So first of all, and we have already started working on that, is to get the finalized. We left a bit aside some of the process plant equipment, the procurement of that. So that is important that we contract that, not only because we ensure that they are long lead items, that they will arrive on time, but we have access to the detailed engineering of each equipment. Okay. And also we de-risk the project from the Capex perspective. We are getting very confident about investment numbers in line with our expectations. So that give us, it was a very important step to do it with enough time. And also it will allow us to push forward with part of the construction ahead of the main construction, that elements I referred to of electricity work, surface work. If you have your own electricity, it's a lot more efficient to build to make the construction rather than have to, and it's more from an environmental perspective, again, a lot better than have to rent or hire some generation in the market. No? So, and some working capital also to allow us to run the process from a strong point of view, the financing effort through a strong position.
All right, I'm going to take this last question because we've run out of time. Ignacio, what grade K20 is the finished product?
So it's K60 is the finished product, no? So
Okay.
and
K60,
so
Daniel? K60.
yeah.
So he says, what grade will that be? Is that the grade K60?
So we are working with, so we are planning in our reserves around 12% grade, and the finished product will be K60, as I say, KCl. Yeah.
Ignacio Salazar from Highfield Resources. What a project you've got. I wish you all the best, and really appreciate you coming on and joining us at the NWR Virtual Resources Series today. Nice to see you.
Thanks a lot, Kerry. Nice to see you. Thanks.